Trevor Mbija. Just wave, kindly wave. I will not tell you to shake your neighbor's hands. Don't worry. I will not tell you to say anything to them. We're not in charge. Thank you so much for making time this morning. It's the 5th Annual Tax Summit. So the theme this morning is tax simplification and digitization for economic transformation. Don't worry about all that kizungu mingi. It's simple. Simplification and digitization. Those are the only things we're going to talk about today. First of all, I'd like you to follow KRA Corporate at KRA Corporate, okay? Start with that. I'll tell you why. Because we have rewards for you. Use the hashtag KRA Summit 2019. The person with the most tweets is going to get a reward from us here. We are monitoring. We have an entire social media team back there. So without any further ado, I'd like to call upon Commissioner Mohamed Omar, my very good friend from the Strategy, Innovation and Risk Management at the Kenya Revenue Authority, to give his opening remarks and welcome us officially to this session. A round of applause for him as he takes up the podium.
Thank you very much, Trevor. Let me start off by thanking all our delegates. I understand we have senior executives from the private sector, government, regulators, my colleagues from KRA, commissioners, staff, our international delegates and speakers. My understanding is that the entire triple helix of industry, academia, and government are all here. So let me just start off by thanking you all for responding to our invitation and coming. I think we do appreciate that. Secondly, my brief remarks will revolve around two areas. I think in previous tax summits, we talked about the genesis and the underpinning rationale for the tax summit. We don't have to repeat that this year. However, I would like to do my remarks in two bits. The first bit is to introduce some of the issues that we are going to be discussing and why we'll be discussing over the next 2 days, today and tomorrow. And then because we want continuity and traction, I'll then talk about what we agreed in the last meeting and what has been done so far. Okay. If I start off with the areas of discussion that have all been picked because they are topical, they are relevant with respect to tax administration, both domestic taxes and customs. And I'm sure you've got your packs, but I just wanted to highlight some of the areas that we'll be discussing. The first one is a topic that is in every conversation and in every dialogue, the issue of the digital economy, taxation. This is a discussion that is being held globally under the OECD. It is happening in Africa. It is happening in all other regions. Okay, and it's not surprising because increasingly our transactions, our economic activities are moving towards the use of online transactions, both in Kenya and globally. With respect to Africa and Kenya, the mobile platform is the major channel through which we are increasingly conducting our business. So whether you are a small trader or a big multinational, there's some form of e-commerce and m-commerce, and I think it is a topical issue that is being discussed. Okay, you're aware of the Africa Free Trade Initiative. We've got the economic blocks, East Africa Community, COMESA, and we are part of the global community. So how do we ensure that we are streamlining our customs systems and processes so that there's a free flow of people, commodities across the borders, so that we don't have non-tariff barriers impeding trade, for example. So the second thematic area will revolve around how we can do that. The other one, and I think we hear as KRA, how do we simplify our tax regime using technology, using our policies and regulatory frameworks. The third area then will be about how do we simplify, okay, for economic prosperity, for taxation, how do we, both for the taxpayer and the tax authority. Then there is the issue of the illicit financial flow and economic crime. That thematic area is about exchange of information. Again, a topic of discussion. It's estimated that illicit financial flows in Africa, in terms of the value, is about $50 billion annually. For Kenya, about $1.5 billion. Okay, so the exchange of information, multilateral instruments that help us exchange information with other jurisdictions, other countries, and other tax authorities is a topic of discussion as well. And then we have in the event of a dispute, okay, tax dispute resolution will be a topic. inevitably there will be differences in perspectives, in the analysis, in assessments, and in the event that, for example, there's an objection to the kind of assessment that you get as a taxpayer, as an organization, there must be a mechanism which is distinct from a very abrasive litigation and the like, adversarial, but an alternative method of resolving the tax dispute. Okay, so that will be also a different session again, as with the other thematic areas. A series of experts will be talking to us about that. So these are all relevant thematic areas with respect to where we are as a country and with respect to the tax authority and tax administration. Those are the ones that we will be discussing. So there are a number of specific recommendations. We should increase the number of taxpayers so that the burden is shared among many. We should look at the issue of we need to align with the devolved system of governance, the counties, to what extent is KRA working with the counties, and updating of KRA taxpayer data. Of course, a lot has happened since then. We are now pursuing a unified taxation system with the counties so that you have a single system, streamlined and unified. And that work is ongoing. I should say that some of the recommendations might require a bit of time, so they are ongoing. Some are already done. Okay, so that collaboration with the counties is really ongoing. In terms of expanding the base, I talked about over 4. By last year, we had just over 3 million active taxpayers. Now we have over 4 million. So in terms of expanding the base, a lot has happened since then. We have brought in a lot of various categories, professional categories, into the tax net. We are working with the micro enterprises, SMEs and the micro enterprises through the introduction of the presumptive tax and the turnover tax, reintroduction of the turnover tax, which is the next point, which is the informal as well. The introduction of ws.studios, *572, some of you might know that. That was an attempt to make it easier and simplify so that the taxpayers are able to comply. Now, in terms of there was, I think, a point about accelerating and supporting the manufacturing sector. Okay? I should say that the socio-economic development of a country largely depends on the extent to which you are exporting or you're having a vibrant manufacturing sector. So at the national level, as you know, Vision 2030 and Agenda 4, manufacturing is central. At KRA, together with the National Treasury, we have now started specific research looking at the structure of the economy. Okay? How do we tweak our policies to support the ideal structure of the economy? If you think about the tax now and look at the numbers, we've got 3 sectors: manufacturing, information and communication technology, and the financial sector. That give us about 54% of the revenue, tax revenue. And yet they constitute just a total of 16% of the GDP. Okay, so that research is ongoing. I earlier mentioned that some might take a bit of time, but we've done some other things that were fruitful. For example, to encourage the cash flow for manufacturers, we've been able to reduce in the current financial bill the withholding tax from 6% to 2%. That was done in consultation with the industry We've heard what you had to say and some of your sentiments, so that people are not, the organizations are not overburdened. The VAT refunds are being fast-tracked, including the introduction of a green channel, framework for low-risk refunds. Of course, at KRA, we now use data, a lot of data in terms of analysis and risk profiling. We're able to know where there might be a higher risk, but when there's none, that has been implemented. The miscellaneous amendment gave a provision for using credits, tax credits, where you're able to utilize those credits for your other taxes. On the issue of e-commerce, as some of you might know, we have been engaging the industry players. We have recently advertised an expression of interest in an attempt to bring in a digital tax partner. And that process is ongoing. We had a series of sessions where we called in the banking sector players, the fintech companies, the regulators, including CBK and the Communication Authority of Kenya. And it's not just in Kenya. The issue of the digital economy taxation is a challenge globally. OECD has put together a task force looking at that. The issue of base erosion and profit shifting is still a challenge. But there are some specific recommendations coming up where countries like ours, and some of the suggestions by OECD include that we should be able to get our proportion of the value created in this jurisdiction, where if you are going online in Kenya and streaming or buying a product online, then the country should get its fair share of the tax. So, in addition to that, and to be sure, digital economy and the taxation of online transactions were taken care of. There's no discrimination in the tax laws, Tax Procedures Act, the Excise Act, the VAT. Any transaction was to be taxed. So we have, with the help of the National Treasury, clarified some of the provisions to just ensure that the issue of the digital marketplace, the issue of online transactions are taken care of and captured under our tax laws. So I think those are the major, the details are there in the report, but in broad terms, those are the specific recommendations. Again, to just reiterate the point that some are already done and some are ongoing. So this summit is a convention where we'll be talking about practical issues and we ensure that there's a follow-up. It's basically a dashboard that we have with respect to what was recommended on the floor and by the panelists, and we make sure that we act on them. In the event that there are extra discussions, we normally have that with industry players, with, for example, associations, KEPSA, the micro players, the Juakali sector. So any extra effort in terms of participation is normally done with specific business management organizations. I wish to stop there and invite Commissioner Mayo to come and give your remarks on behalf of the Commissioner General.
All right, a round of applause for Commissioner Omar and Commissioner Mayo as she goes up. Thank you very much.
The Chief Administrative Secretary, the National Treasury, Honorable Nelson Gachuhia, Senior Deputy Director, Micro and Fiscal Affairs, Mr. Wanyambura Mwambia from Treasury, the KRA Board, government representatives present here today, especially the ICT Authority, Ministry of Interior, Central Bank of Kenya, Kenya Bureau of Standards, our sponsors, Safaricom and EABL, that is breweries. Ladies and gentlemen, good morning. Good morning once more. You are not happy? It is my pleasure to join you here today as we officially open this auspicious annual event, the 2019 Annual Tax Summit. This is the 5th time Kenya Revenue Authority is organizing this great event. The Tax Summit is part of KRA's Taxpayers Month activities, which aims at bringing together experts from different sectors to discuss some of the pertinent tax issues affecting the nation. Ladies and gentlemen, this year's event is themed Tax Simplification and Digitization for Economic Transformation. The notion that taxes should be simpler is one of the very few debates in tax policy that generates collective agreement. However, we know how important tax is in the development of any country. Therefore, simplification of tax needs to be approached with a lot of understanding by all the players. We all agree that simpler taxes has numerous benefits. They can reduce taxpayers' cost of complying with the tax laws in terms of time and money. Hence, it will increase the probability and productivity of enhancing revenue. It is for this reason that KRA has supported tax simplification, expected to enable taxpayers to conveniently pay their fair share of taxes, not a shilling more, not a shilling less. These measures are, among other things, expected to enable additional business entry and expansions, as well as boost mass entrepreneurship as we now focus on tax-based expansion to enhance our revenue collection. Ladies and gentlemen, simplification of tax measures is not only about lowering tax compliance costs, it is also about providing taxpayers like our small entrepreneurs with a conducive commercial environment which allows them to explore their capabilities. Reduced tax compliance costs can encourage increased small SME creation and compliance with the tax system. Ladies and gentlemen, KRA has continued to invest in technology to simplify taxation. One of the effective technologies KRA has established is the iTax system, which is now in its 5th year in operation. The system has eliminated major bottlenecks that taxpayers used to endure while interacting with Kenya Revenue Authority. Currently, taxpayers can access almost all KRA services at the comfort of their homes. KRA is currently working towards increasing the distance to frontier, that is DTF, points by 9.4 points. This is expected to improve ease of doing business ranking to position 45 globally by 2020 cycle. To achieve this, KRA has initiated integration of iTax and NSSF online systems. The systems were unified by February 2019, and now KRA and NSSF has scheduled to roll out the first set of 90 pilot employers and ultimately all employers by December 2019. Full rollout of this system to reduce the number of payments will be by 12. from the current status. Other than simplifying taxation through digitization, KRA has also invested in technology to improve investment levels in the country. Recently, KRA commissioned scanners at the points of entry. This is a major milestone in the fight against illegal importation and exportation of restricted and prohibited goods, as well as sealing revenue leakages. In the past, our borders have been an avenue through which contraband and illicit goods have been finding their way into the country. Ladies and gentlemen, just like dumped goods, illicit and contraband goods have also been posing a monumental challenge in the market of genuine products, thereby denying legitimate entrepreneurs their rightful opportunity. KRA has also installed smart gate technology at the points of entry that automates the capturing of container and vehicle registration marks and numbers. This is prior to the release of cargo from the ports and container freight stations, that is the CFS, effectively phasing out the manual processes and enhancing the integrity of cargo release records. These are just but a few of the many measures KRA has put in place to fully facilitate the ease of doing business in this country with a view to maximize returns for the business community, as well as ensure enough revenue for the government to protect the economy of this nation. Ladies and gentlemen, I believe that by the end of this forum, we shall have developed fundamental concepts which will become the pillars of the country towards achieving its goal of being self-sustainable. I wish all of us successful and fruitful deliberation as we chart a way forward for this nation. Thank you for your audience. God bless you. God bless Kenya.
All right. And now it is my humble pleasure to introduce Honorable Nelson Gaishoy here. He's the Chief Administrative Secretary, National Treasury and Planning.
Thank you very much, the KRA board members who are present here, the commissioners who are also present here, the chairperson and CEOs of various organizations, government officials present, taxpayers and consultants, our sponsors, Safaricom and EABL, distinguished guests, KRA staff, ladies and gentlemen, good morning. Let me say that on behalf of National Treasury and Planning, we are honored to be here today during this annual Taxpayers Summit, annual Tax Summit. We also want to thank KRA for bringing us together to participate in this 5th Tax Summit. This year's theme is tax simplification and digitization for economic transformation. As you are aware, Kenya has embraced innovation in technology and digitization, developments such as blockchain, artificial intelligence, unique processing power and widespread connectivity through mobile devices that has created a myriad of opportunities for innovation, employment and empowerment that were previously not available. The current expansion of Kenya telecommunication infrastructure capable of delivering efficient and affordable info communication services is recognized as a critical requirement for the country's economic growth. The availability of such infrastructure is a great step towards the development of the global market. In this regard, the government has automated most of its operations. This has enhanced accessibility to the public and improved service delivery. For example, introduction of systems like e-citizens have brought faster and easier access to government services. The government has implemented online platforms such as iTax, integrated customer management systems, customer relation management system, cargo scanning management solutions, and accessible goods management system, among others, as strategic instruments to simplify taxation and minimize operational costs. The iTax system as we've been previously told, has, for example, made it easier for taxpayers to access KRA services. The automation of KRA processes has also led to notable success in filing returns, remitting payments, applying tax refunds, lodging tax obligations, application of tax waivers, and requesting tax compliance certificates, among others. Following the implementation of online systems in tax administration, we have observed that levels of compliance have steadily improved over the years. Digitization, therefore, allows the government to operate with greater transparency and efficiency. In conclusion, I believe this forum will provide a good opportunity for all of us to deliberate on tax simplification and digitization that will define and improve our taxation policy with the aim of boosting resource mobilization. So I wish you all the best as you embark on the deliberations. It is now my privilege and pleasure to declare the 5th summit officially open so that we can have good deliberations and make sure that we improve our tax collections and also the efficiency in our tax systems. Thank you and God bless you.
All right, thank you. Tax statutes. He's also a member of the Kenya Double Taxation Treaty Negotiation Team and is the vice chairperson of. It's a round of applause for him. Engineer Daniel Obam. Engineer Daniel Obam. Engineer Daniel Obam is the Communication Secretary, Ministry of ICT. Engineer, just make your way to the podium as well. He's an expert in policy, regulatory, and operational aspects of ICT, especially telecommunications and broadcasting. He has led development of national ICT policies, strategies, and master plans, including the roadmap to migration from analog to digital TV in Kenya, the national ICT policy, the national broadband strategy, and the Kenya Digital Economy Blueprint for Africa, among others. He's currently the chair of the Task Force of Development and Digital Economy Strategy for Kenya. You know, on social media, round of applause for him as well. You know, for the young folk in this place, this is what we call goals, yeah? When I introduce myself, I just say Trevor Mbija, journalist. That's it. I'm a muti ya kufunga nyama, like they always say. Let me call upon the next panelist as well, Dr. Catherine Getao. Dr. Catherine Getao is the CEO, ICT Authority. Dr. Catherine Getao is the Chief Executive Officer of the ICT Authority, a state corporation under the Ministry of ICT in Kenya, with a broad mandate towards the provision and regulation of ICT in the public sector, as well as promoting ICT capacity and stimulating the growth and development of the ICT sector. A round of applause for her. She comes up as well. Thank you so much. Let me call upon another panelist as well who's going to take part in this particular session. That would be Mercy Ndegwa. Mercy Ndegwa needs no introduction. She's the regional head of policy at Facebook. Mercy Ndegwa. Mercy, a round of applause for her. She comes up as well. Thank you so much. And last but not least, we have Titus Mukora, partner PwC. Titus was the first person to come here in the morning. A round of applause for him for keeping time. We were here at 6 a.m. and Titus was here as well. Titus has over 15 years of professional experience gained in law, tax, and transfer pricing. He spent 3 years with PricewaterhouseCoopers, South Africa and Johannesburg office, specializing in transfer pricing. Here, he was engaged in documentation and planning studies for some of South Africa's biggest mining and oil companies and consumer goods manufacturers. All right. So this session is going to be moderated by one person who needs no introduction as well. My friend, Philip Mwema. He's the founder and managing partner at Anderson Tax Kenya. A round of applause for him as he comes up. He has over 20 years of experience in tax advisory, commercial strategy, and structuring, from advising business and investors on power purchase agreements and production sharing agreements to setting up operations across East Africa for tax efficiency and commercially viable resource exploitation. All right, so the keynote address is going to be made by none other than Dr. Alexander Ezenagu. Dr. Alexander Ezenagu obtained his doctorate degree from McGill University in Canada in international tax law. He's a graduate of the University of Cambridge, United Kingdom, where he obtained a master's in law, in commercial law as well. Dr. Ezenagu's research focuses on the relationship between taxation and economic development, as well as the role of government and non-government institutions and actors in creation of tax policies and rules as well. A round of applause for him as he goes up. Right now, he's an investment and tax law expert, International Center for Tax and Development. So how this is going to work, once his session is done, the moderator will take over, pose questions to the panelists, and then we'll come to you. All right?
So I'll be speaking on policy perspective to the taxation of digital economy. It is common knowledge that our world is undergoing digitalization of the way we do business, where we do business, how we do business, and when we do business. We are awakened daily to new innovative ways to carry out economic activities and earn income. Innovation is not limited, just as we've come to learn that no human is limited. Our economic realities are altered before regulation can capture these new forms of businesses, and tax administrators are left playing catch-up. In this new era, there are two things we can all agree on: that innovation must be regulated, and that innovation precedes regulation. As Professor Bitange Ndemo rightly puts it, you cannot regulate that which is yet to form. Taxation is one form of regulation with the utmost relevant purpose, the collection of revenue to provide infrastructure. Other reasons we tax are to redistribute wealth, reprice the cost of commodities and services, in most cases to affect behavior, and finally to achieve representation. Recall the truism, no taxation without representation. My speech today will focus on the first limb of why we tax, to raise revenue. The power to tax is contained in the domestic laws of countries. For example, Section 3 of the Income Tax Act of Kenya provides that a tax to be known as income tax shall be charged for each year of income upon all the income of a person, whether resident or non-resident, which accrued in or was derived from Kenya. Similar provision can be found in the income tax law of Nigeria, to the effect that tax must be paid on profits accruing in, derived from, brought into, or received in Nigeria. Note the separate emphasis on income and profits in both jurisdictions. I shall return to this later. The fiscal sovereignty of a state, that is, the power of a state to govern its revenue affairs in its own territory without outside interference, is an essential quality of statehood. It must be stated clearly at this point that only domestic laws of a state can grant and take away the taxing rights of that state. Therefore, a country has unrestrained power to govern its revenue affairs, if only in theory. However, as we have observed in the Kenya-Mauritius tax treaty case brought by the Tax Justice Network Africa, countries can willingly give away their taxing rights for the purpose of attracting and retaining investments. The viability of this wisdom is beyond the scope of this speech, though I'll be willing to offer my opinion if probed further on it. Where countries decide to enter bilateral agreements for the purpose of allocating taxing rights from economic activities which occur in both states, there exists an international mechanism for that. This international mechanism dates back to the 1920s, over a century ago, where in order to rebuild states after World War I, it was important to remove barriers to trade among countries. A few things to note about this era. First, these meetings were held among the then superpowers with no African representation. Second, the business approach was essentially trade of goods and services and portfolio investment, with very few firms engaging in foreign direct investments. Third, economies were not yet globalized, nor were they digitalized. In their wisdom, these then superpowers accepted to allocate taxing rights among countries based on the residence and source rules, against allocating income based on economic activities in each state, though the experts were introduced to and considered the economic allegiance theory postulated by John von Chance. The economic allegiance theory recommends allocating taxing rights among countries based on the economic activities in those countries, apportioning the profits therefrom using a formula. I shall return again to this later. The outcome of the residence and source rules is to grant primary taxing rights to the resident state of the multinational entity, while such states are able to tax only when they can establish some relationship. This relationship could be in the form of subsidiaries incorporated in the source jurisdiction, as envisaged in Article 9 of model tax treaties, or presence of permanent establishments, branches if you may, as envisaged in Article 7 of the model tax treaties. The second aspect of the resident source rules was the introduction of the arm's length principle. Recall that at the center of bilateral tax agreements is the allocation of taxing rights between countries where related entities carry on economic activities in both countries. The aim of a bilateral tax agreement is to prevent the double taxation of income owing to the multinational group as a whole, just by having related entities in both jurisdictions who transact each other. Thus, relationship is at the center of the international tax architecture. Against electing to recognize the relationship between the entities in the multinational group and apportioning the group profit based on a formula, the founders of the international tax system recommended that these related entities be treated as independent entities would. This arm's length principle computes the profit of the subsidiary or branch in the source state without regard to the other entities in the multinational group. In simple terms, the arm's length principle treats the entity in the source state like an orphan, though surrounded by a strong support system. To assist taxpayers and tax administrations in applying the arm's length principle, the OECD has since 1995 published transfer pricing guidelines. Most transfer pricing rules of countries, including Kenya, are modeled after the OECD's transfer pricing guidelines. The legal status of these transfer pricing guidelines depends on the domestic laws of taxing jurisdictions. Though generally regarded as soft law, they've been given some form of legal effect in some jurisdictions, even in countries that are not members of the OECD. For example, Nigeria and Kenya have, through legislative and judicial pronouncements, given legal backing to the application within their jurisdictions. Many of us here are aware of the case of Unilever and Kenya Revenue Authority and the judgment of the court on the applicability of the OECD's transfer pricing guidelines to tax practice in Kenya. I comment no further on that. To other tax jurisdictions, the transfer pricing guidelines are mere persuasive instruments at best. For instance, in a recent judgment of the High Court of Malawi, the court held that where local legislation provides for the law, it is always imperative to apply that law and use any international instruments as mere instruments for interpreting that law. The legal status of the transfer pricing guidelines notwithstanding, tax authorities in most tax jurisdictions aim as far as possible to keep in line with the transfer pricing guidelines. Hence, the quasi-legal nature of these transfer pricing guidelines poses some limits on the ability of countries to choose the approach most suited to their conditions for attributing income to MNEs within their jurisdictions. The arm's length principle suffers from both foundational and procedural flaws. The preferred transactional approach limits the analysis of the relationships between entities in a corporate group to individual facts and circumstances analysis of each transaction entered into by related entities. The purpose of this individual analysis is to ascertain that the transfer price set for each transaction between related entities conforms to the same price one of the parties would have fixed with an independent party, or a price two independent parties would have fixed for a similar transaction. This comparability analysis aims to find the most reliable comparables for transactions between related entities. To effectively carry out this comparability analysis, a tax authority must have sufficient technical knowledge of the business of the taxpayers, the business model, the product transferred, and the terms of the transaction, among others. This, as we know, is a very difficult task. In addition, this approach, that is, the individual facts and circumstances analysis, fails to recognize the economies of scale, scope, synergy, and the interrelation of diverse activities created by integrated businesses, which are integral to the corporate group. It denies the fact that the commercial activities of related entities are not necessarily decided on standalone transactional basis. Business transactions between related entities are structured to promote the common enterprise and increase the total profit of the corporate group. This, the arm's length principle, fails to appreciate. From a procedural angle, applying the arm's length principle incurs high cost of documentation, unpredictability of outcome, months spent going through audit of taxpayers' returns, possible adjustment of taxable profits, leading to long-drawn court cases to resolve disputes arising therefrom. A burden the OECD itself recognizes in the 2017 transfer pricing guidelines, where it admitted that applying the arm's length principle could be a resource-intensive process and could impose heavy administrative burden on taxpayers and tax administrations, worsened by both complex rules and resulting compliance demands. I'll give you a little context. The Federal Inland Revenue Service of Nigeria, as of 2018, had 32 officers involved in transfer pricing audits of more than 2,900 taxpayers who are subject to transfer pricing rules. These 32 people were responsible for auditing the tax returns of thousands of big multinational companies who are engaged in economic activities in the country. Compare this number to the transfer pricing unit of KPMG Nigeria, which consisted of 18 dedicated, well-trained, and incentivized staff who daily advise their clients on transfer pricing matters, while also enjoying support from other KPMG offices across the world. Kenya, as of 2017, had only 12 staffers of the Kenyan Revenue Authority auditing the transfer pricing activities of hundreds of multinational entities who do business in Kenya. It is easy to see the mismatch here and the potential for unchecked tax avoidance practices by multinational groups. There's a very good paper published in 2017 by Professor Atiya Waris of the University of Nairobi on Kenya's implementation and adjustment to challenges in international transfer pricing regulation. I highly recommend it. Furthermore, the complexity and scarcity of comparables for benchmarking purposes have contributed to the increased tax avoidance in African countries. Sample data analysis from Nigeria and Uganda show that these countries lose approximately 3 times of the potential revenue pre-audit. Even at that, revenue recovered after assessment and audit reflect concessionary gains as against a functional analysis of each transaction of the taxpayer and ascertainment of arm's length pricing for the sales of goods and services as required by the treaties and the transfer pricing guidelines. This implies that the tax gap in most African countries could be as high as 70% as against the United States, where it is below 20%. We can connect our underdevelopment as a continent to our inability to collect due tax revenue. These limitations of the arm's length principle in achieving accurate transfer prices for goods and services transacted between related entities lead to transfer mispricing. Transfer mispricing occurs when transfer pricing goes wrong. Transfer mispricing refers to the willful manipulation of the transfer price by related entities, either to return high taxable profits in low tax jurisdictions or return low taxable profits in high tax jurisdictions. This is a common way of shifting profits from one jurisdiction, in most cases, the jurisdiction where the economic activities occur and value is created, to one used as a conduit for tax minimization purpose, in many cases a low tax jurisdiction. The notoriety of these low tax jurisdictions is that no real economic activities occur or value is created there. They are simply organizational circuits to minimize the tax liability of companies at the detriment of the taxing jurisdictions where the economic activities occur. The Paradise Papers, series of publications by the International Consortium of Investigative Journalists, chronicle the complex structures used by companies to shift and hide profits away from the jurisdictions with legitimate claim to them. Mauritius, an African country, has over the decades earned the reputation of being a tax haven on the continent and accused of depriving taxing jurisdictions the taxes due to them. Some taxing jurisdictions, such as India, Rwanda, and South Africa, are renegotiating their tax treaties with Mauritius with the goal of protecting their tax revenue. Transfer mispricing is part of the global tax avoidance architecture and falls under the scope of illicit financial flows. Due to the tax avoidance consequences of the current international tax system, its foundation has come under increased criticism. The growing agitation is whether the almost century-old global tax system is still relevant and fit for the 21st century. Also, if it is adequate for the taxation of the digital economy. It would appear that a global consensus has been reached that the current international tax system is not fit for purpose and must be abandoned for a new system that guarantees that tax is paid where the economic activities occur. The OECD, the gatekeeper of the arm's length principle, said in January 2019 that it is now willing to seek solutions that go beyond the arm's length principle. The global debate, which many of us are part of, is what the solutions should be, especially in the context of the digital economy. I advance to contribute to the global debate and emphasize the importance of achieving a system that promotes economic growth and development. Before I go to the policy options that we can consider, it's good to quickly remind us of what I have said so far, and that is that the global tax architecture is built on two key principles: the profit allocation rule and the nexus rule. The profit allocation rule demands that we treat members of the multinational enterprise as separate from each other. The nexus rule presupposes that for a tax jurisdiction to tax the profits of a foreign company earning income in its jurisdiction, the company must have physical presence in that jurisdiction or in tax balance permanent establishment. Articles 5 and 7 of most double tax avoidance agreements, modeled after either the OECD or United Nations model tax treaties, provide for what would constitute a permanent establishment and how that permanent establishment is taxed. The growth of technology and the growing importance of digital economy call into question the wisdom of the physical presence requirement in today's digital age. Note also that in both instances, profit allocation rule and the nexus rule, the arm's length principle applies. Latest reforms by the OECD seeks to treat the multinational group as a single firm, while applying both the arm's length principle and formulary apportionment in the allocation of the global profit of the multinational group. This latest proposal, which came out last week, will split the global profit of a multinational group into a three-tier profit allocation mechanism. 1, a deemed residual profit to be allocated to market jurisdictions using formulaic approach. 2, a routine profit to be allocated using existing transfer pricing rules. And finally, an additional profit to be allocated through binding and effective dispute prevention and resolution mechanism. Tax practitioners anticipate that these new reforms will be palliative, complex to implement, retain the heavy emphasis on documentation, and possess the limitations of the arm's length principle. I shall spend the remaining time discussing options African countries can consider in taxing the digital economy. The first consideration for African governments is whether they desire to tax the income or profits of taxpayers. The relevance of this distinction is obvious when considering the policy options. On continuous taxation of profits, a viable alternative is the adoption of the unitary taxation plus formulary apportionment approach to income allocation. Unitary taxation treats entities of the multinational group as a single firm for tax purpose. It consolidates the accounts of the group as a whole to produce a global profit. It proceeds to apportion the global profit among the entities in the countries where economic activities have occurred using an allocation formula which takes into account both the supply and the demand side of income generation. Sales is one contribution to income. There are other factors of production which make up the formulary apportionment approach. These factors are assets and labor, and alongside with sales, have been known to be used by countries in apportioning global profits within their jurisdiction. However, we have observed the addition of users as an additional factor to capture the uniqueness of the digital economy. We have also seen the recommendation of an only sales factor in the apportionment of the global profit for the digital economy. While this may be appropriate, that is, an only sales factor, for some aspects of the digital economy, it is an inefficient one-size-fits-all approach, as some aspects of digital economy are labor-intensive and reliant on significant asset composition. Proponents of the unitary plus formulary apportionment approach believe that this would offer a more reliable means of curtailing base erosion, particularly over the long term, than attempting to apply a mixture of politically vulnerable and often only partially effective anti-avoidance measures. So Pisoto puts it more succinctly. A unitary approach would replace three major elements which create fundamental problems for taxation of multinational entities. One, the need for detailed scrutiny of internal accounts and pricing for the negotiation of adjustments based on the absolute principle. Two, the need to deal with profit shifting within the firm, especially using tax havens by complex anti-avoidance measures, such as rules against thin capitalization, controlled foreign corporations, and abuse of treaty benefits. Three, source and residence attribution rules. To summarize, a unitary and formulary approach to profit allocation will significantly reduce tax avoidance by multinational entities and protect the domestic tax bases of countries without disincentivizing international trade and foreign direct investments. It will also achieve inter-nation equity, inter-taxpayer equity, and neutrality. On the radical departure from taxation of profits to taxation of income, a serious option to consider is the adoption of the alternative corporate minimum tax. The alternative corporate minimum tax, proposed by my colleague at the International Center for Tax and Development, Michael Dost, taxes the revenue or turnover at a nominal rate of, say, 1%, rather than the corporate income tax rate of 30% on profits. The argument by the proponent of the alternative corporate minimum tax is that on a turnover of, say, $10 million, you are likely to receive tax of $100,000 if you apply a minimum tax of, say, 1%, as against applying 30% to the likely net profit of $200,000. This approach of taxing revenue at a minimum rate of, say, 1% has been used by low and middle income countries to prevent erosion of the corporate tax base. In some cases, instead of being used as an alternative tax, it has been used as an advance payment that is creditable against the corporate tax liability at the end of the fiscal period. Where the advance payment is higher than the final corporate tax liability, a refund of the difference may be returned to the taxpayer upon request. A minimum tax is targeted at both companies with international transactions and those without international transactions, making them applicable to solely domestic companies, a departure from the existing transfer pricing practice. The advantage of the alternative corporate minimum tax is that it is less distortive as it is applied on revenue at a very low rate. Also, it is simple and easy to apply and provide certainty. There is no need for information on comparable data, nor information on foreign ownership or related party transactions. The alternative minimum tax is immune to avoidance through the overstatement of deductions. This includes immunity to avoidance through interest deductions, as well as deductions for management fees and the cost of goods sold. There are economic arguments against turnover-based taxes. Taxing gross revenue could subject investors to risk taxation even in the absence of economic profit. As such, alternative corporate minimum tax may be seen as economically inefficient. There's the argument of arbitrariness in setting the rate of taxation. The alternative corporate minimum tax is vulnerable to underpricing of outbound sales of goods and services, but the quantitative effects of the underpricing should be small compared to the effects of taxation of profits. A third policy option to consider in the taxation of digital economy is the use of withholding taxes on fees paid for transactions. African countries can impose withholding taxes on outgoing payments of interest, royalties, service fees, transactions on digital platforms, either as a minimum tax or an advance payment. This also could be employed as a generic measure against several forms of profit shifting. Similar to the alternative minimum tax, withholding taxes are simple and relative to apply. Given the limited administrative capacity of African countries, this is important for tax administration. In the same way, withholding taxes may be considered to be arbitrary as they are on the gross amount of transaction fees without making provisions for expenses. Also, taxpayers could transfer the burden of the tax to the consumers by grossing up the fees to cater for taxes collected by the revenue authorities. As such, it calls for a cautious implementation. Administratively, revenue authorities may seek to amend their treaty provisions to accommodate these policy options. This could be done independent of the ongoing OECD BEPS project or in alignment with it. However, one way to go about this from both legal and administration standpoint is through the establishment of a safe harbor regime for the digital economy. A safe harbor regime is an administrative simplification regime for a category of taxpayers or transactions. A safe harbor regime ring-fences a category of taxpayers or transactions and prescribes to them an allocation method. This method could be one of the policy options mentioned above, that is, the unitary taxation and formulary apportionment approach, the alternative corporate minimum tax approach, or the withholding tax approach. Also, safe harbor regimes could adopt any of the OECD's transfer pricing methods as originally intended, though I strongly advise against that. The advantages of a safe harbor regime for taxing the digital economy is that they reduce the burden of tax compliance and ease the administration of the tax system, while at the same time providing tax certainty. Safe harbor regimes have the potential to ameliorate the compliance burden involved in establishing the arm's length price for transactions entered with related entities. For tax authorities, safe harbor regimes can help to ensure effective management of limited resources needed for tax enforcement. Finally, they may be used to secure and increase corporate income tax of taxing jurisdictions. However, safe harbor regimes can be discriminatory against other sectors or taxpayers. They can provide tax optimization opportunities for accountants and lawyers and may achieve double taxation or double non-taxation where they are unilaterally imposed. Thus, their cautious implementation is advised. Countries use safe harbor regimes to achieve efficiency in tax administration and reduce the compliance cost and burden for taxpayers. Those safe harbors are not an exact science. They are recommended for African countries, especially in the taxation of the digital economy, as they achieve a compromise between the need to protect the tax base through strict adherence to transfer pricing rules and a desire to reduce the compliance and administration burden on taxpayers and tax authorities. In conclusion, corporate income taxation remains an important contribution to the revenue of most African countries. However, taxing companies, especially where they have related entities and transact with each other, is fraught with challenges, as highlighted above. The existing global tax architecture for taxing related entities has been adjudged to be impractical, inefficient, complex, costly, and unfit for purpose. As such, countries seek simplified approaches to tax-related entities with the hope of providing certainty and predictability to taxpayers while guaranteeing ease of administration of the tax system and collection of revenue. I have discussed some policy options here that can be considered and do hope we can discuss these further in the next 2 days. Thank you for your attention.
Moderator, over to you.
Thank you. Thank you. And Alex, you raised quite a number of issues in your conversation. Just to kick us in, Maurice Oray, putting things in context and in perspective. In 2018, the European Commission proposed the introduction of a digital services tax.
fast forward this year, I've seen in the Finance Bill 2019, I think we've taken a cue out of the Europe and introduced taxation of income derived from a digital marketplace. And the Finance Bill then defines that digital marketplace as a platform that enables direct interactions between the buyers and sellers of goods and services through electronic means. My question to you then, Maurice, is picking up from Alex, that the tax administration is taking a catch-up. The world is flat. What mechanisms have you put in place to tax this digital economy? If I'm to pick the statistics from Alex, where in Nigeria we have 32 officers dealing with 2,900 companies in terms of our transfer pricing in that realm. What's the level of preparedness by KRA and, in effect, the National Treasury, Maurice?
Thank you very much, FCPA. First of all, before I talk about what we have done as Kenya, it is important to note that the taxation of digital economy is a digital challenge across the world. And as a matter of fact, and coming from the main speaker, there has to be rules, domestic rules, to govern taxation of any item. However, it is also important that those domestic rules be aligned to the international tax rules. And therefore, when you look at what we have done, the first important thing that we do is to ensure that our domestic rules are aligned to the international rules. And probably, and actually, not actually, probably, actually, that is the main reason why, despite the pressure that has been coming from a section of the public, we have not moved ahead to redefine permanent establishment. Because you cannot have your own permanent establishment as Kenya, yet the world has provided for a clear basis on which taxation of permanent establishment should be based. But going back to the issue of what have we done in terms of policy direction in taxation of digital economy. And I want to say with a lot of confidence that the current tax rules in Kenya do not exempt taxation of transactions carried out through a digital platform. That is very important because when you look at, for example, the Income Tax Act, Section 3, which the main speaker talked about, it is very clear and it says that the income that is generated from Kenya is taxable. It doesn't say the mode. It doesn't say that if it is through a digital platform, then it is not taxable. The same thing applies to the VAT Act. The VAT Act says the supply of goods and services consumed in Kenya is subject to VAT. Then, what is it that we should do? The most important thing that we need to recognize is that the transactions of a digital platform are unique. One uniqueness is that they are not visible. Then, how then do you address the challenge of visibility? How then do you now provide in the tax policy framework how you deal with the issue of visibility? One of the things that we did in the Finance Bill 2019 was, first of all, to bring into clarification that taxation applies to transactions carried on through a digital marketplace. That was a clarification. It was not introducing a new law. The second thing that we did for VAT is to bring in the issue of reverse VAT. You saw that we changed it. Because when it comes to VAT, there are two issues that need to be addressed. Because VAT supply has two forms. There's the supply of goods and services to a business. So it's a business-to-business transaction. Then there's the supply of a good or a service between a business and a customer. In terms of services which are carried over a digital platform, for registered persons, those of you who can recall the provisions in the VAT Act currently, the ones that are subject to what we call reverse VAT is only the ones that are supplied to a registered person. The ones that are supplied to a person who is exempt is not subject to VAT. But then what does that mean? Because for a business, it will put in the financial statements, it will say that we incurred the following expenses on, for example, purchase of software or purchase or provision of management services. Then the taxman will be able to see that you incurred a service which should be subject to reverse VAT. But for a person who is not registered for VAT, the law exempted them. What does that mean? They will not collect VAT on services that are consumed by that business, particularly assuming that the service is from outside. Now, what we did in the finance bill is to say that even persons who are not registered will be subject to reverse VAT. So it means that a person who is doing business and consumes a service, a management service from outside Kenya, he will be required to pay VAT. And there's a trail, because if he pays for that service, he'll be required to charge reverse VAT. The gap that is now remaining is how then do we deal with those services that are transacted over a digital platform and are between business to consumers. Because a consumer will not prepare a statement of accounts, you will not trace them. So that is the gap that currently I would say we are addressing in terms of VAT. The gap for income tax is more difficult. It is more challenging because, again, a person might ignore to put in the transactions that are carried over a digital platform and is doing business in Kenya. The speaker talked about the issue of nexus. A person will carry out business here in Kenya and earn profits, and those profits cannot be traced because it's not here in Kenya. Then how then do we manage those kind of situations? Under the Tax Procedures Act 2015, under Section 15A specifically, we have got provisions that require a person doing business, an unresident person doing business in Kenya, without nexus, without presence here in Kenya, to appoint a tax representative who will pay for the taxes that he is supposed to have paid. And in the event that that person doesn't appoint a tax representative, then the commissioner is empowered under the Tax Procedure Act to appoint a tax representative for them. Then that takes us back to the issue of withholding taxes, because the speaker mentioned the issue of using withholding taxes to address digital economy issues. The challenge that we have on the issue of withholding taxes is one. Withholding taxes might not address the intention that the policy wants. Because by charging withholding tax, what most businesses will do is to load the withholding tax on the consumer. So the tax gets hidden. It is not a tax on income, but it becomes a tax on consumption. So you are still not addressing the issue of the tax burden. And that is why the engagement on the issue of the nexus, redefining permanent establishment, which will allow for taxation on the person who is doing business is important for us as Kenya. And I want to say that Kenya is a member of the inclusive framework, which is working on the issue to address digital economy. But we are happy that part of the work that is being done has also provided for short-term measures. And when we talk about short-term measures, I believe most of you saw the EOI that we put in the papers, specifically to find a way of using the legal framework that exists now to find a way of tapping or collecting the tax in the process of payment. So we collect the tax through the payment gateway. That is the basis of that EOI that we put across, and is, I would say with a lot of confidence, that the issue of collection of the tax is aligned to the provisions of the current law. What I would say that maybe we need to find a way of engaging further so that we ensure that the loopholes that will be left. I talked about the issue of the final consumer for VAT purposes. How are we dealing with the issues of VAT surrounding the consumption, particularly when the goods and services are provided, and the services are provided by non-resident persons?
Maurice, I'll come back to you on three things: the nexus rule, the withholding tax, and the issue of the alternative minimum tax. Just hold the thought there. I'll come back to you, and I want to bring in Mercy Ndegwa, who's a head of Facebook, head of policy at Facebook, into this conversation. And Mercy, if you look at the growth of the digital economy, we've seen the emergence of quite a number. The taxi-hailing apps, be it Uber, Taxify, Bolt, Little Cab, they don't have vehicles but operate an infrastructure that riders ride on and get a commission. The hotel accommodations, Airbnb, Agoda, and they link you up to a potential client. The loan applications, the tellers, branch, they determine and give you credit score. If you look at Facebook and the emergence of that and purchase of goods online, I mean, be it Jumia, M-Pesa thing, Kilimani Kill, and all is coming into play. From where you sit, Mercy, being a player in that industry, what's feasible? Okay, are tech firms looking at shifting operations from a core line of business where they're engaging in fintech? What are your thoughts?
Thank you for that question, and thank you so much for having me also on the panel today. That's a very important discussion we are having, and I think it's one that as Facebook we are very interested to have, and is something that we have even publicly through our founder and CEO, Mark, indicated Facebook's interest to have this conversation and see what can be done to be able to address the concerns that were cited very elaborately, for example, by Dr. Alexander, and now by the head of policy at tax. And one of the, to just respond to what you're saying, I think the challenge is understanding that digital economy in itself. I think there is, you've given examples of various companies that are operating in the digital space. The digital space is complex in its nature itself. It's very pervasive, and what we see is a situation where there's different companies with very different interests operating very differently from a tax perspective. And I'll give an example of what that means. If I give you the example of Facebook, for example, you have a platform that brings together people to connect socially, so friends, in terms of, I am on a platform, I get to know about you, I add you as my friend, and we are communicating socially, and on there I could find out that you're trading or doing something that may involve a commercial activity and so on. But from a Facebook perspective as a company, we do not have visibility, for example, of the communication or engagement that you're having on our platform. He's raised the question of business to consumer, for example, as an issue. And it is definitely an issue of importance, and we'd like to be able to discuss that further, and why we're here today even. That, you know, there's an extent to which we need to understand that for a company to be a digital company and of the size and scale, for example, of Facebook, the possibility of even operating physically in every jurisdiction where we have presence or are present is even impractical. Currently, Facebook has presence in about 200 countries. Is it practical to have an office in each and every one of those countries? It is not, because at the end of the day, if you look at the way that Facebook as a business operates in terms of the model, it doesn't justify for you to be able to set up shop in every country. So I think being able to understand how the digital economy works, and particularly the different interests of each of the organizations that are in the digital space, and what that means in terms of taxation is important. And for Facebook, we are interested in having this conversation because we want to be able to understand the concern. We want to be able to contribute to the solution that then gets derived of how then do we address businesses that are not your conventional business, which is what most digital businesses are. Make sure that the frameworks we come up with in regards to addressing tax concerns are frameworks that traverse jurisdictions, are more global in their perspective. I like the idea of the inclusive framework, which Kenya is part of, which we are also very supportive of. When you have over 134 countries discussing within the OECD framework a solution, and you've heard Kenya already say that they are supportive of where the outcomes and direction that we're seeing, we approve of that, and we think that that is a good direction to take, because we need to find a solution that addresses the presence of companies such as ourselves that will not have a physical presence in a market. And I think these kinds of discussions are exactly what we are hoping to have, so that we can be able together to come up with something then that works. Yeah.
Thank you, Martin. As I come to Engineer Bam, who's the Communications Secretary at the Ministry of ICT, at the point we'll take questions from the audience and have interactions, so we'll have a mic rotating at some point. But Engineer, just coming up to you, as ICT, the digital economic blueprint and the pillars, how do those then tie in to what the National Treasury through Maurice are trying to do in terms of just bringing that digital space into the income tax realm, as Maurice indicates?
Thank you very much, Mr. Mwema. Maybe first to just note, perhaps I'm one of the least qualified to be on this panel, because I would be more comfortable to talk about telecommunications and the fact that the loudspeakers are not optimized for my position where I'm seated than talking about tax. But I have some tax experience because I file my taxes every year dutifully. So it's, in case somebody is taking a record, that's for the record. I'm here because our PS was invited to come. Then he told me to come, so I had no option but to come. But I thank KRA for reaching out to me after I was given that instruction and giving me the confidence that I could actually talk about this issue. First of all, for me, I see that maybe within our lifetime, we'll not be talking about digital economy and the economy. The economy is moving towards a digital economy. So I think we need to start thinking about frameworks that will support the digital economy, be they taxation or any other. Now, going back to the digital economy blueprint, the blueprint was born out of a request by African countries for Kenya to showcase what is informing the digital transformation of its economy, because they think that we are doing things well, both from a policy, a legal, and regulatory framework. So the Ministry of ICT, working with other stakeholders, including KRA and the National Treasury, actually developed the blueprint, which was launched by our president in Rwanda in May. The blueprint has 5 pillars, just for a summary: digital government, digital business, infrastructure, innovation-driven entrepreneurship, skills. And then the 6th pillar is what we are calling the cross-cutting pillar. And in this pillar is where we have policy, legal and regulatory frameworks that can facilitate the other 5 pillars. Now, if you look at digital government, these are transactions. And these transactions, at one point, may need to be taxed. So tax does come in there. Digital business is transaction on business, seamless transactions. And what we are looking at in developing a digital economy strategy is actually having a single digital market, not just within Kenya, but actually within East Africa, and also after the principle of the Africa Free Continental Trade Area, which aims to make Africa a single digital market. Therefore, if we are aiming to expand our market beyond our borders, then of course the issue of taxation does come in. So in developing the digital economy strategy right now, we again have brought in all the stakeholders. The Kenya Revenue Authority is a member of the task force, the National Treasury, the Central Bank, and other stakeholders. Right. And one of the reasons why we brought in these stakeholders, KEPSA is heavily represented, is to look at, as we look at the more technical aspects of it, also look at these emerging issues like taxation. Under the pillar of skills and values, this is where we are addressing the issue of the Ajira Digital Program, where we are trying to create jobs for youth. Yes. We are told that the youth population in Africa and of course in Kenya is burgeoning, but we don't have enough jobs for them. So the direction we are trying to point them is to get digital jobs. So if they are going to get digital jobs and earn money, then at one point the issue of taxation on those platforms will have to come up. And therefore, the work we are doing in the development of the digital economy strategy surely will depend a lot on the policy direction that our taxation regime takes. And my view, maybe personal view here, would be that perhaps it's not a jurisdictional decision maybe as a country, but perhaps we need to look at international frameworks. Like our guest speaker talked about the OECD framework, maybe look at what the Europeans are doing. And whatever we do, and I'm glad that our colleague is saying that whatever they're putting in place is actually aligned to what is being discussed internationally. Because our market is beyond Kenya is bigger than our country.
I mean, talking about the market, engineer, if we look at the replication of Silicon Valley in Kenya and Africa, it's yet to actualize or realize its full potential. From where you sit, what are the two critical areas that as a country we need to put more effort and focus to get in that level, given the world is flat?
I think we need to focus on job creation using digital platforms. Oh. And number two, we need to have these digital platforms need to be seamless and very easy to expand. And if we have platforms that are integrated, then it becomes even easier for example, taxation to see what is happening on these platforms. Oh. So I would say that focus on connectivity, because I'm from the Ministry of ICT and we do connectivity, yeah, as my colleague will talk about it later. But we need to build platforms that are seamless and can allow us to trade freely without any hindrances, be they financial transactions or interaction between different platforms.
Thank you, engineer. And as we build platforms, that is in right next to Catherine Gitao, whereby engineer says we need to build platforms to create the jobs. Then we'll have increased interactions of devices and users. Massive data will be disposal at government and businesses. Data being a critical component on digital transactions. As a country, Kenya, we're yet to get into the Data Protection Bill 2018. Looking at Europe, they've adopted the General Data Protection Regulation. Where are we? And what does this have
to do? Thank you very much, Philip, and thank you, Dr. Ezenagu, for a very enlightening presentation. And is it still morning? Good morning, everyone. Yeah, so it's a privilege to be here, although like Engineer Obama, I'm far from being an expert in this area. I'm not in the ministry anymore. I'm now an implementer, not a policymaker. Okay. So I may not be the best person to ask the question about where the data protection legislation is. It isn't actually in my ambit.
Okay. Fair.
Yeah, but maybe I'll answer the question you didn't ask.
Sure.
Firstly, I'm not a prophet, but I believe that this is a very timely conversation because I believe that the internet or the digital space or the cyberspace is going to become a major market, a major place of doing business. At the same time, governments are going to be under more stress in a number of ways. One is that the citizens are going to be demanding more in terms of services, more in terms of the quality of service, more in terms of the range of services than ever before, because these are citizens who are comparing their government with the rest of the world. At the same time, citizens may be less loyal to governments. We are every day exposed to scandal, criticism, discussions, comparisons, and so on. And with this global marketplace, I think it's more difficult to collect taxes. So governments will need more money, and they'll find it more difficult to collect the money that they need because people are transacting in a space that makes it quite challenging for them to collect those taxes from unwilling people and companies, corporates. And then the last point I'll make in line with what Engineer Obam has just said, and also I think Mercy made a similar point, although not in the same way, is that there are going to be less and less people who are in formal employment. Now, formal employment makes it simple to collect taxes because you have simplified tax regimes such as pay as you earn. But I believe in the future there will be less and less of those people who are on what we call a payroll, where you can get pay as you earn. So I believe this discussion is timely, and I hope there are going to be very difficult questions from the audience about what are we going to do in the face of these changes. Obviously, we have to do something. The internet should not become a tax haven. But we do have to answer the questions of sovereignty and jurisdiction, and I was happy that Mr. Ezenegu at least enlightened me further on the meaning of sovereignty and jurisdiction in the cyberspace. Now, the question which I prepared for, which I thought was the one you were going to ask me, is there any negative impact to tax? And I didn't want to answer that because being a government official, I'm very dependent on people paying their taxes. So I don't want to give them any further reasons not to pay. However, these are some of the things which I've heard. It obviously increases the cost of doing business. Businesses would be happier if they didn't have to pay taxes. It may lead investors to choose where to locate. And as we were discussing this, I thought the internet may become a place where people choose to do business simply because it's more difficult to make people pay taxes, and that's not what should happen. It may create barriers to entry, because perhaps in this conversation we've been thinking about the Facebooks, and I wanted to challenge Mercy that despite the fact that people are doing business on Facebook, Facebook also has a business model. And you must be making money from those people who are doing business, so we want those taxes at least. It moves, one of the arguments I hear, I'm not sure I'm convinced, is that it moves money from the private sector to government, and that the private sector is a better investor of money than government is. I'm not sure that's true, but that is an argument I've heard. But I think the most persuasive argument for me, as somebody from the technology realm, is that it may be very, very difficult to apply fairly the taxation of the digital realm. There are all sorts of technological reasons. Yes, you may catch the people who are paying through the payment gateway using conventional means like cards and M-Pesa. But how will you catch those of us who are using the Bitcoin? Yeah, so we'll just move from using cards to using coins, which you can't trace. How will you deal with encryption? So there are many practical and technological reasons why it will be very difficult to apply taxation fairly in the cyberspace. And I think this is something which must be discussed. I'm also persuaded by the arguments which were brought up that the capacity we will need and the expertise that we will need is something which we are far from achieving, and therefore we must also have a discussion about how we will acquire that capacity and expertise to fairly apply tax in this area. Otherwise, we'll all just run away to the tax haven that is the parts of cyberspace which you cannot reach. Thank you very much.
Thank you, Kate. Thank you so much. And last, I think, Alex, you talked about the alternative corporate minimum tax being applied within the digital space. Shed some more light, and in light of what you've seen in other jurisdictions, what are your thoughts about Kenya? The application of that alternative corporate minimum tax and in terms of the rate?
So it's a lot easier when you're sitting than when you're standing. So I think I'm more comfortable with this. So the alternative corporate minimum tax at the moment isn't necessarily applied in the digital space, but from studies, it becomes a very viable alternative. And how it works is this. At the moment, what we tax is profit. Now, profit basically means gross revenue minus everything else a company throws into it. Cost of goods bought, expenses, and all of that. And so for instance, a company may have a revenue of $10 million. By the time it takes away all expenses, the net profit is $200,000. So even if you have a very high tax rate of 30%, but you're basically getting 30% of $200,000. Okay. That is around $66,000. However, if you charge an alternative corporate minimum tax of, say, as minimum of 1%, which, by the time you tell it to anyone, it sounds like a very negligible rate, but you're taxing that on the gross revenue. 1% of $10 million gives you $100,000. $100,000 compared to what you'd have got as 30% of net profit is way higher. So again, it becomes, and beyond just the numbers is that you're not asking a company for its profit. You're simply saying, how much revenue or turnover have you made in a year? Now, it is very difficult to actually downplay that particular amount. The way you could do it is simply to reduce the cost of goods that you've sold, the price of it. But then that is also applicable if you were going to tax profit. So in the end, what you're simply saying, let me look at your financial statement and see what you've made in a financial year, and I just apply 1% to that amount. Now, a lot of countries actually use it. In Pakistan, they use it, and also some Francophone African countries. They either use it, as I mentioned, either as an advance payment to say, I'm going to calculate 1% of your revenue, you pay me this amount, and then by the time you calculate under the existing transfer pricing system, if you're meant to pay lower, I return to you, or I use it as a credit. If you're meant to pay higher, you pay me. But also what people have done is to use it as an anti-avoidance measure. So because I know 1% of your turnover, and you come to give me what you've declared as your taxable profit, I can compare. And then I go for the higher one. So in terms of simplicity, in terms of even revenue optimization for the tax authority, and even for the taxpayer, knowing that it's just a 1%, you don't have to employ, the KPMGs and PwCs and all these other guys, to start doing transfer pricing documentation. All you just have to say is, this year I've sold X number of these, and I've made $1 billion in revenue. Can you collect 1% of it? So it works for taxpayers. It works for tax administration. Those who will suffer are the accountants and lawyers.
But clearly, I think Alex wants us to retire early, pushing through. Now, going through this alternative lower tax in the digital space, what are your thoughts? Maurice?
Thank you very much. Maybe I'll avoid the discussion about presumptive tax unless it's very necessary, but I wanted to emphasize something about the alternative minimum tax. And because they're not the same, the presumptive tax and the alternative minimum tax is not the same, though it's also the alternative minimum tax is also on presumed basis. But I would like to say that the framework for alternative minimum tax is something that we have thought about. Okay. Because from two perspectives. One, to address the digital economy. Secondly, is to address perpetual loss-making companies. There are companies in this country which have not paid tax for the last 30 years. I can say that with confidence and have figures. So it's an important debate that we need to engage on, and it's a debate that we have initiated now at the Treasury. And I believe that going forward, once we get enough details, then we'll implement it. What I'm aware of, leaving out the digital platform, close to 23 countries all over the world have provisions for minimum tax, alternative minimum tax. On digital economy specifically, the alternative minimum tax, if you look at the EU recommendations on the digital service tax, it's basically an alternative minimum tax at the rate of 3%. Yes. Look at what India has. Is it also 3% in India, which they call equalization levy? I know countries like Mexico have around 6%. 6%. And it's an issue that we need now to think deeper to specifically address the digital economy, particularly when you are going the payment gateway. Then a minimum tax of 1 to 3% would be more ideal. Whether that should be used as an advance payment, say for withholding taxes, that is another issue that we need to consider. But I agree that alternative minimum tax will, in the short term, will be very ideal for developing economies like Kenya. Although, again, it suffers the same risk that I mentioned, that ultimately you will end up taxing the consumers here because the product manufacturers or the service providers will load it on the service users. So it has its disadvantages, but carefully structured, it can be of great help in the short term. The issue of presumptive tax, I said I wanted to avoid it, but just to say that the main reason on presumptive tax was to expand the tax base and bring the people who are not in the tax base to the tax base. Then we restructure the system. That was the main objective.
Thank you.
We should not look at it as burdening the small person. Otherwise, thank you.
Thank you. I think let me take a question from the audience, and I'll take them in 3 forms. So, all right. 1, 2, 3. Be upstanding, say your name, pose your question to the panelists, and then we'll take it from there.
Okay, here you go.
Thank you very much. It's on. Thank you very much. Thank you very much, Mr. Moderator. My name is Robert Suna. I work with the Tax Justice Network Africa. I have a question and maybe a recommendation. The question goes to Mr. Orey. Have there been any mechanisms or strategies at the East African level to design approaches of taxing the digital economy? The reason I'm asking that, you may find Kenya is a member of the inclusive framework, which is OECD driven, and Uganda is not, or Tanzania is not. In the spirit of the East African community, there have been any efforts to find a taxation policy targeting the digital economy? The second advice may be based on the introductions from the panel, where some members were admitting that this taxation discourse is very alien to them, I think it poses a challenge, or it challenges all of us in the room as to what extent can we deliberate on issues of taxing the digital economy. So as one of the way forward, I think it would help to have stakeholder engagements on this matter, such that it does not appear, I always tell people that taxation is a whole of government approach. So it does not appear a KRA issue, but it is an issue for all stakeholders. And it can be even drilled down to the wananchi, because if it can be complex for us in the room, what happens to the person on the streets of Nairobi? I submit.
All right. So thank you, Robert. The second question, we'll take a set of three.
Good morning, Matt from Strathmore. Given Kenya...
sorry, your name, please?
Martin Bayer, Strathmore University, the business school.
Good.
Given Kenya's economy is about 9.8 trillion shillings, $98.4 billion, I hope my math is right. I would like each panelist just to guess, doesn't matter what basis you're using, to guess the size of the digital marketplace in Kenya. Just throw a number, doesn't matter how you arrive at it. Thank you.
Good morning. My name is Esther Moshiri Otieno from the Catholic University of Eastern Africa, currently a PhD candidate at the University of Nairobi, pursuing a research on digital taxation. Now, I have a question to Alex. I would like to, now that you've suggested a question on tackling corporate minimum, to identifying it as a way forward, then how is it possible to ascertain that a specific company, a digital company, has its specific presence in a specific jurisdiction, so that now you can suggest issues on ascertaining a minimum, corporate minimum tax on its revenues in that specific jurisdiction? And then the other question I have is, are you suggesting a voluntary compliance in terms of declaring their revenues to specific tax jurisdictions? Then number 3 question is on how do you strike the balance between digital corporate tax income taxation in terms of efficiency and addressing questions of tax avoidance in any jurisdiction within Africa?
Thank you. Thank you, Esther.
Moderator, if I may, just so we get a feel of how many people have questions, kindly raise your hands. All right. So moderator, you'll take them in batches of 3 at your permission.
Yeah, sure. Maurice, I think Robert has an interesting question, and over to you, the approaches.
I want to say that we have got East Africa Community Technical Forum for the Commissioner Generals that deals with administrative tax issues. We also have a committee on harmonization of domestic taxes, which deals with how the East African communities can, for example, harmonize tax practices and legal frameworks for income tax, VAT, and excise duty. And I can tell you that, yes, the issue of digital taxation is being addressed in the East African Tax Harmonization Committee. And again, as I said earlier, the digital taxation, because it involves a lot of international transaction, it must be aligned to the international tax rules. And that is what that committee is doing in terms of that specific issue.
Your guess on the size of the digital marketplace? What number do you guess?
Yes. On the second question was about engagement with other stakeholders.
Yes, and the second from Martin Mbaya was each panelist banting a number in terms of the size of the digital. What's the size?
Yes, I might not have the precise figures, but I'll give you one area where, for example, we can actually get the exact figures. For example, the mobile telephony. If you look at the transactions that go through M-Pesa, it is in excess of 5 trillion. So if you could use that, then you can actually visualize what the whole framework of the digital economy has in terms of economic potential.
Okay. At a good base. Thank you, Maurice. Alex, Esther, on the 2 questions.
Yes, so I'm not going to guess as to the number. I'm neither Kenyan nor a panelist. I'm just messing around. No, but so as the possible to ascertain presence in a taxing jurisdiction. And I think that I probably did not say it strong enough that the answer to many of the tax issues that countries have, especially African countries, is simply in the exercise of the fiscal sovereignty. And what that means and how that is stretched is left to the amount of political will that you have. So if you look at, again, the Income Tax Act, it says that every income derived in or accrues in Kenya is taxable. It doesn't say threshold. Now, the OECD would provide a threshold of 750 million. And let me just say this. While there are merits to being part of the inclusive framework and taking part of, being part of that discussion, I think that a lot of African countries should ignore the inclusive framework propositions. And I have said this at the East African Revenue Commissioners meeting. I've said it at the East African Revenue Technical Committee meeting, simply because those solutions are not African-centric. Alternative corporate minimum tax is not being discussed at the OECD. Neither is withholding tax in the sense that you want it. Neither unitary taxation or formulary apportionment. And even the latest reform still owes on to residual profit and routine profit that we all know has failed. Again, but back to my point, is that the whole issue should be if there is an economic activity taking place in your jurisdiction, that economic activity, if it has monetary value, should be taxed. Now, either it comes in money or monetary value, it should be taxed, and that is in compliance with the laws of most African countries. As I said, that's Section 3 of the Income Tax Act of Kenya. Now, am I suggesting voluntary compliance? Well, that is always the starting point, but we know that if you're going to bridge the tax gap, you would have to go after taxpayers. And the idea for us today is not to think that, oh, because we don't know the number of taxpayers in this space, we're not going to start anything. No, let's start with taxing the Facebook and Uber and the Google and everybody that we know that we can hold on to. We can hold on to Messi today and, insist that she drops something. And we hold on to the Uber people, insist they drop something. The moment you start with those you can hold, then you can start thinking about solutions for other people. If you are waiting to have a foolproof solution to taxing digital economy, we will keep losing billions of dollars in revenue. And that is the truth. We need to look at low-hanging fruits and start from there. Then how do you strike a balance between income taxation and tax avoidance? Anyone who tells you that any solution will be foolproof is lying to you. However, the discussion that we're having is how to reduce the tax avoidance activities that go on in revenue collection. So the question becomes, if I again, as I mentioned, if my tax gap is 70%, or even not even my tax gap, in my PhD thesis, by the time I did analysis from Nigeria and Uganda, I found out that 300% of tax revenue is not being paid by companies. If I can bring that 300% to 100%, that means I have more money to provide infrastructure for other things. So I'm not here trying to propose a foolproof solution, but I'm here saying that there are different options we can consider. There are places we can start from. We can start from short-term measures that we've discussed while having the big picture of the long-term measures. We just keep losing money as a continent simply because, one, we're either waiting for the OECD to tell us what to do or we're waiting to get that foolproof solution. Let's exercise our fiscal sovereignty in a way that ensures that we collect the revenue due to us. Thank you.
Thank you, Alex. We'll take the next set of 3 questions. Trevor?
Okay. Go ahead.
Thank you. My name is Janet Wandia. I work with Glovo. You've given us some insightful solutions on how to better tap in the tax on the revenues being made in the digital space, but I'm concerned about 2 things. Number one, how do we ensure that the different agents in the digital space are not double taxed? And as Dr. Catherine and Daniel mentioned, if this happens, this will be passed on to the consumer. And this leads on to the second question. When this is passed on to the consumer, as you all know, the world has now become a global village. How do we not stunt Kenya's economy through taxation because eventually I'm a customer. If something in Kenya is 1.5 of the price that I can find internationally, I can easily go online and find the same thing from Amazon, for example. How do we ensure that we do not shift this from local market to the international market through the taxation?
All right.
My name is Makambito from Mobile for Good Solution, that is a mobile application. My question basically goes to digital platforms. And on a case scenario, I want to ask about the betting applications that are online. Of late, there's been a controversy where some 2 big companies have pulled out of the country. And their complaint is that they are being pushed through to unfavorable taxing regime. So my question is, when you are entering into a sector, there's a specifically taxable regime that you have to adhere to. But when you enter into that sector and maybe KRA see that you are making supernormal profit, they change the goalpost. Is that actually supposed to be? Thank you very much.
Thank you. My name is Abigail Bundi. I'm CEO and co-founder Amari Consulting Limited, which is an e-commerce consulting firm. First, I'd like to say congratulations to Gary. This is a very timely discussion. It's a very same discussion that happened at the World Trade Organization last week in Geneva, and I was privileged to attend. So I can say we are not very far behind from what the rest of the world is discussing. And so I'm glad that Mercy is also on the panel, because my question then is, you have said something very important, that the digital space is very complex. And key to getting the regulations right is to involve the stakeholders. So then my question to Maurice is, as we are crafting these regulations, to what extent are we pulling the stakeholders and sort of like the private players onto the table so that what we come up with is enabling for trade? Because I believe, and we believe, the ones who are in this digital space, that e-commerce and digital platforms are actually the fastest tool that are going to open up trade in Africa. So it's very important that whatever regulations we come up with are enabling for trade and not that are going to make it harder for people to trade online. So I think it's very important that we have the stakeholders and sort of experts in that digital space to contribute to the crafting of the regulations. And the second question is pretty much still to Maurice. In terms of national laws versus international laws and what should flow where, we always have the issue of policy playing catch-up with digital. We are still far behind. The rest of the world is talking virtual reality and AI and things like those, and we are yet to catch up. But it doesn't mean that we don't do something. But at the same time, as we are trying to see what the international world is doing and what the rest of the world is doing, we should be aware of our domestic and home context, so that whatever we come with is very customized to our reality. So I think my 2 questions really are, to what extent are we engaging the experts, so to speak, in the digital space in formulation of the policies? And secondly, are we going to wait for international laws to sort of adapt to them, or are we going to have our own national laws? And then when the rest of the world comes and says you should do 1, 2, 3, we are like, okay, no, I think we won't adapt to this one because our market says 1, 2, 3, and we have laws to protect that. Thank you.
Thank you, Abigail. I think we'll take 2 more questions, Trevor, to make them 5. Yeah, thank you.
Thank you. My name is Pascal Matogi from Fortira Consulting. First is an observation on the minimum tax, which is based on gross revenues, and then a question to Dr. Ezenagu. So you do realize that the revenue, in some instances, is derived from group companies. So in essence, whatever is reported as a revenue is something that has been impacted by the trending between companies and the pricing between intra-group entities. So if you are then taxing that number, subjecting it to a minimum tax, it will still be impacted by whatever multinationals are likely to do, which is play around with the numbers that are there. So the question that I do have then is, how then do you restrict or stop multinationals from maybe moving or shifting that revenues, let me say artificially, so that whatever is being taxed, whatever tax base is being taxed at the gross revenue is not impacted by, this intra-group trend. Thank you.
Thank you.
Yes, my name is Francis Kerr from National NGO Council. Mine is a concern. As you know, Kenya is 80% is a Christian nation. When I get my salary, I pay as you earn to the government. When I go to church, I pay 10%. When I go to supermarket, I pay VAT. It seems that Kenya is overtaxing their citizens too much. We need to come out of this narrative. We need to come up with a good policy to save Kenyans from this let me say, a colonial system. Thank you.
Great. Thank you. I'll attempt actually just to respond to Care in there. So when you get your employment income, indeed you pay PAYE, that is tax that you pay. And in context, tax is the price you have to pay for being in a civilized society. When you tithe your 10% or sadaka in church, it's a choice based on your belief. Okay? And in terms of VAT, or the very annoying tax, again, not everything is vatable. One of the things when the VAT Act 2013 came into play, we ensured that the basic commodities were not subject to VAT. So again, it's a choice when you decide to consume the luxury products which are vatable. Hooray to you for James Wandia and the rest. Yep, yeah. So James Wandia from Global, on the issue of agents, double taxation, and be passed on to the consumer, and obviously coming out of that is the issue of the BEPS, the base erosion and profession. Off to you on James Wandia.
Thank you very much. The first question that came from Wanja was about how do we ensure double non-taxation. I've got to say that the only way that countries all over the world avoid double taxation is through agreements. And therefore, it is important to note that for the Kenyan tax administration, we have got certain what we'll call unilateral tax reliefs to enable you to consume without double taxation. Specifically for Kenyan individual citizens, it is provided for. But on other areas, unless we have a double taxation agreement, it might be difficult to avoid issues of double taxation. Then how then do we ensure that there is some fairness in the taxation? Is for the government to expand the treaty network. That is the only solution that we have. And I can tell you that the government, through the National Treasury, is working to ensure that we have got as many treaties as possible to relieve double taxation. Currently, we have got 16 treaties which are in force, but we are expanding them through engagement with other multinationals. The other issue of passing on taxes to the consumers. This one I mentioned that some of the ways that we might use to collect taxes through digital platform might have effect on actually us taxing our own consumers than taxing the income of that non-resident person that is doing business in Kenya. Then the obligation actually also rests with the consumers, because consumption is a choice, and you look for the best pricing. So this is one thing that might not be avoided in terms of passing the cost to the consumers in the short term, because I told you the long-term measures, particularly issues of permanent establishment, the nexus rules, will ensure that if you are an non-resident and you want to do business in Kenya, then you have to pay the taxes on your income. Because one of the things that I need to mention also is the issue of multilateral instrument, which Kenya has signed, as is in the process of signing, to ensure that we have managed to, it's not multilateral instrument, it's called MAC, Multilateral Agreement Convention, that allows Kenya to contract with another state where the businesses are carried in Kenya, and that state, one of the articles in that instrument is what we call administrative collection, assistance in collection of taxes, where if you say that you, instead of paying your income tax, you load it on a consumer of Kenya, then Kenya has a right to ask the other jurisdiction, how much did you generate and how much did you pay in tax as tax in Kenya? So the instruments also become very important in terms of the policy framework around the digital economy.
The other question, Maurice, was from Mark on the issue of betting application online and the favorable tax regime on betting companies. And I guess the question there is the betting application online, how then, given that it's gone digital, how then do you have visibility now that it's gone online?
Yes, I think there's an important comment that the name is a bit complex to pronounce, made in terms of KRA shifting goalposts. I want to say that taxation is based on very specific principles. It's not just KRA or the National Treasury deciding that today we are going to increase the tax on betting or increase income tax. Specifically on betting, there are deeper issues, policy issues that are considered in determining how much taxes to be applied. And all of you know that there are negative externalities that result from betting activities. And how then do you address those negative externalities without interfering with the playing field? The best option is to use taxes as a basis of deterrence. And therefore you'll find that the rates for the betting taxes, which have been the major contention, has been changed to ensure that it is aligned with the effect that it causes in terms of social activities. So that is the main reason. It's not about changing goalposts. And I believe if it is the issue of winning taxes, which was introduced in 2017, then the element of what constitutes winning has actually gone even to the point of arbitration by the courts, and the courts have actually agreed with the KRA. So it's not about changing goalposts.
Okay, and then Abigail, coming out of Geneva, indicates that yes, commendable. I think a week later, KRA is having a forum on taxation and digital. So clearly, as you correctly say, KRA mko tech. So how are you engaging the experts and the internal laws? How are you getting the players involved in terms of just coming up with the laws that affect the digital economy?
Thank you very much. I'll start with talking about the constitutional framework. Our constitution is very robust in terms of how the policies surrounding government activities are managed. The requirement that before you enact a law or provide a regulation that you must engage the public is very clear in the Constitution, and we have always abided to it. And all of you might remember that every year before the National Treasury starts the budget process, they put a public notice inviting the public for their comments. Then those comments are compiled, and again the document becomes a public document, and even in Parliament, the public are still invited to put in their comments. At KRA, we also have a very elaborate policy in terms of engaging the stakeholders in implementation of the laws that are govern the taxation. And I believe that maybe we need to pay attention to the publications that are made by the National Treasury, either as public notices or legal notices, because the legal notices currently are not effective unless the legal notice-making body proves to Parliament that there was consultation with the public. And I think that is that basically covers the concern. Maybe we need to be just aware and be watchful on those notices that require input from the various stakeholders.
Yeah, I think on that, Boris, I think the challenge is, yes, the public notices will come out in the dailies, in the print. You're now taxing and getting to the digital space. Maybe the public participation now needs to move into the digital space, be it IG, Twitter, Facebook, and engage the public using those media platforms. I don't know, what are your thoughts out of it? Yes, Alum.
I think the issue of involving stakeholders came from Robert initially when he said some of us confessed that we are at sea in this panel.
Yes.
And I'm the one who confessed that.
Yes.
And then Abigail also brought it up. In the Ministry of ICT, the way we do our public participation, as Maurice has said, is a constitutional requirement. But we normally publish the documents on the website, we put out notices in the newspaper, and then we do have forums where people actually do come and make contributions. And talking about this particular forum here, you can see we are Facebook, policy, KRA, implementer of projects for government, experts, universities, somebody from the NGO Council. This is a multi-stakeholder engagement in discussion. So I think this is commendable, and this is just the beginning of the discussion. And I would like to say that for us, last week, the Public Service Commission actually asked the ministry to submit. We were signing some lists here with our names, telephone numbers, and everything. The only thing we were not asked by KRA was our bank accounts. I don't know if they already know that. But the Public Service Commission actually asked us to submit original documents showing that people actually participated when we were developing the next review of the national ICT policy. So this actually is a requirement, and we are actually asked regularly by the Public Service Commission as public institutions to prove that we carried out public participation. So that's it. Sorry, Chair, there was a question which you asked Dr. Kate Gitawa about the status of the data protection and whether we have any legislation that side. Because I'm involved in that, maybe I thought I could give clarification for the benefit of those who are here. You mentioned the GDPR, the General Data Protection Regulations in the UK, I mean in Europe. The digital economy is going to have a lot of data, and people will get confidence in giving their information and their data on these platforms if they know that that information is going to be secure. Therefore, the Ministry of ICT has developed a draft data protection law, which has already gone through the first reading in Parliament. It was published. Last month, the National Assembly Committee on Communication, Innovation and Information went around the country collecting views, and I think now they're in the stage of analyzing those views. So we hope that you saw that and you submitted your comments. And after the first reading, it will go to the second reading, then the third reading, and then after that, if all the comments are taken on board, we'll have a law. So that's on course, and that will be a very big enabler for the digital economy.
Excellent. Thank you, Engineer. we'll take the last set of 3 questions, then I'll come back to each of the panelists for closing remarks. Last set of 3 questions, Trevor, and then we can wrap it up.
There's a question here that I've been given on a piece of paper. It goes to Mercy. They say, what can Facebook propose as an appropriate taxation model for the digital economy? All right, we have another question on the farthest end.
Yes, my name is Davis Simiu. I'm a private businessman, and I am a student at KICC. I wanted to ask KRA over the issue of electronic tax registers, electronic physical printers, and electronic signature device. And when I say so, I have enough and overwhelming evidence, because these machines are not used to the required standard. I visited certain supermarkets within the Republic of Kenya, and I just want to say direct, because we want to collect revenue. Nakumat supermarket, no, this Tuskys, now we have Tuskys. Tuskys supermarkets issue receipts that are not fiscalized. They have some selected point of sale or buying goods where the receipts are not fiscalized. And this is a challenge to KRA, and there is a weaknesses in KRA because KRA rules and regulations have limited their employees to do work between 8 a.m. to 5 a.m. So this brings in these business people who want to fail to pay, to give out the ETR, to sell goods on Sundays, to sell goods on public holidays, to sell goods at 9. Even these clubs, like Carnival, they sell goods and they don't give ETR receipts. What is KRA trying to do so that it can collect revenue on weekends, holidays, by use of these machines? Question number 2. Most of these machines, according to me, I've seen some are fake, some have not been fiscalized, and they are being used by these business people. Have KRA got these people, like surveillance people or intelligence people, moved around to confirm whether these machines are authentic or not? Another point goes to petrol station within the Republic of Kenya.
David, I think 2 questions. We can take up.
The last one is on petrol station, which you said that you are supposed to charge 8%. And these petrol stations are not charging 8% on petroleum products like diesel and kerosene. What is the take of KRA? Thank you.
Good afternoon. My name is Aisha Kartar from AH Adam Investments. I have one question that will touch on 5 areas, but I'll make it very quick because they're very basic. I have a problem with installment tax. I'm not liable to pay installment tax because I have a tax credit brought forward, where I have a profit, but then once I pull in the tax credit brought forward, I end up with a tax carry forward. And if I don't pay installment tax, I end up getting a penalty in iTax. So I need help with that, because what's been happening now to avoid the penalty, I've been paying installment tax just to be on the safe side based on the profit that I have, disregarding the tax credit that I have. Then the other question is, for directors' fees which are declared, the bonus is declared after the audit. Normally that we are allowed to declare those by 30th April of the following year. But what happens is, if you do that and then you file, sorry, my question is directed to CPA Maurice Oray. I didn't mention that, but anyway. So once, for the directors' fees, these relate to the previous year, and they're declared by, they're payable by 30th April of the following year. And when ITax does not allow us to do this. It forces us to pay it in the same year. Because if you file on 30th April, what happens is it creates a liability in ITax. And I consulted some KRA experts and said that's an issue that KRA is looking into, but I'd like a solution on that. Then the other thing was the VAT inconsistencies. It's costing a lot, it's adding a lot of administration costs to us in that if I've declared all my sales and my clients, for instance, do not indicate the same reference numbers, like if my invoice is 3200 and they use a different invoice number in their system to capture that purchase on their side, it creates an inconsistency. Any difference, even if they declare if they capture the invoice in a subsequent period than what I declared, then it still creates an inconsistency where I get a report saying I have not declared and I'm declaring everything. I have my books available for KRA to look at. So every month I choose. You see, we are in property management and we invoice rent every month, so that it's pretty straightforward. But if my client maybe takes the purchase in the following month, I'll have an inconsistency. If they use a different invoice number, it'll generate an inconsistency. I have to write to KRA, so it's a lot of additional costs. The last one, I wanted to know, is TOT still in force? Because I thought presumptive tax came to get rid of that, but I saw it in the finance bill that it's mentioned.
Okay, wow. Thank you.
My name is Philip Ogola from the CEO of Fogo Group of Companies. Now, I have 2 questions to address. Number one.
Philip, one.
Yes.
It's one question.
It's one question, okay. When we are talking about the taxation of digital economy, there is one thing that we are still not addressing. Number one, all the transactions in digital economy are either being done through mobile banking or through the banks. And even when we talk about the chips like the Bitcoin, it's a wallet. The wallet has to be loaded. And when you are loading a wallet, it has either to pass through a card. Now, my question is, does it mean that KRA, through collaboration with the CBK, they cannot trace these transactions so that they look for these people one-on-one?
All right.
Just to finalize on that, again, there was the introduction of Blue Chip, which was to help in all transactions, and it was supposed to come in place somewhere in 2017, 2018, and the ETR machines were changed. This thing has taken long, and actually it gives a room for most of the suppliers, most of the business people to avoid, they give the room for the issuance of even fake ETR receipts. And the person who will be looked is the person who purchased, not the person who issued it out. Thanks a lot.
Thank you, Philip. And we'll begin with Mercy. I think, Mercy, the first question is, how do you propose that the taxman taxes Facebook and the rest?
Thank you for that question. I was actually hoping that question came up because, like I said, I think it needs to be clear that Facebook as a company is interested in having this conversation on how we can address the question of tax and how to apportion what has been generated in each jurisdiction to that jurisdiction in question. Now, having said that, I think a very important statement that was made yesterday in a meeting that I had was a statement that I think actually really wraps this up in a way, because they said that taxation follows business, not the other way around, which means that if then the business landscape has changed such that now we're talking about a digital economy that we have identified so many challenges just in this room. The gentleman who has just spoken has asked the question of how do you trace financial transactions. There's questions about enforceability. How do you monitor even these transactions, which tied to the question of voluntary compliance. How do you know what I'm giving you is actually correct? There's like a lot of challenges we've already identified. And I think the question we need to take away with us as we are addressing this issue and looking now at what our proposal then is that in these spaces where we are, whether it is in the OECD process or in the treaties that we're signing or multilateral agreements that we're having globally or in the region, there needs to be like a clear push for what it is we want. So I do not agree, for example, with the view that the OECD process is exclusionary or is not representative of Africa. I think it is for Africa then to represent itself in those, and we do have African countries within the OECD process, for instance. And so I think it is just coming out very clearly and assertively in those spaces, because the way the digital landscape is today, it is, like I said earlier, it is impossible to have physical presence within each market in which business is being done. And I think it's recognizing that and then saying, what then will be the tax policy that can address this? And to answer the question, I think that we need to think about a model that is simple, to be able to attract the foreign direct investment that you talked about. Empirical evidence already shows that there is a negative correlation between foreign direct investment and taxation in a country. We need to look at a way to make sure that companies are interested in coming that market. The reason why you cite or you see companies moving into markets that are friendly from a tax regime, it's for that reason. We can attract more foreign direct investment by having favorable tax models within this country as well. I think there's also a need for us to address or align the position within the country. So for example, we have a very clear objective from the digital economy blueprint that is being spearheaded by the Ministry of ICT, that wants to position Kenya as a leader in the digital space. Is this aligned with, for example, the aspirations, for example, of the National Treasury? We need to have some form of alignment so that then we are clear, are we working together in that way? Then now we communicate to the world what it is we want. What do we want to attract more people? Because when you look at what the digital space has done, and these are things we cannot ignore, the social impact levers within the digital economy are so much so that you know that the jobs that will be done by majority of the children who are being born today and that are there today will actually be jobs that will be invented in the future because of the presence of digital landscape, for example. We know that the ease of doing business today and the cost of doing business has been significantly reduced because of having that space. If you look at the political levers, for example, like the example I've just given, the alignment is necessary also within the country in regards to what direction do we want to take in the policy that we choose. So for us as a company, we would like to have this dialogue, and which is why I like the suggestion of a multi-stakeholder engagement, because it brings all of these views of, we see the challenges, visibility of transactions is a problem, the multiplicity of transactions is also a big problem. To be able to even identify whether a sale occurred here or in another market is also a challenge. So if we can have all of the experts around the table, being government, private sector, and all of those who are interested and concerned, as well as industry, coming together and identifying what then works. And we are saying as a company that for us, what would work would be not having requirements, for example, of physical presence. It is impractical for the reasons I cited earlier. Secondly, what would work would be something that allows for a global approach, so to speak, something that we can be able to apply easily across markets. It needs to be very transparent and clear, so then it's very easy for us to be able to determine what's the cost of doing business, how then can we come and show up in that jurisdiction, and so on and so forth. So I think some of these things need to be addressed in the consideration of what then is a suitable policy for Kenya.
Thank you, Mercy. I think more is, so David Simiu, clearly a very good student of Dr. Fred Mugambi at KESRA on issue of fiscalization. Your comments on the issue of ETRs and fiscalizations and the issues around that. And then you can just tackle also Aisha's matter on installment tax, director's fees, and the VAT.
Thank you very much. One thing that maybe before I make general comments on the issues that have been raised, I have to clarify that we may not discuss taxpayer issues on this forum because taxpayer issues have some level of confidentiality. So what I would request the person, Mr. Simiu, if he could get in touch with me, I'm seated on the second row, then probably we can talk about all these things about taxis, the petrol stations and the rest, and we get a better position on how to address them. Because what you have said touched on what I would call tax evasion. So we cannot discuss them in this forum. Good. But I would also like to mention to Simiu that we have reviewed the ETR regulations, and it is under public participation. I wish if you could get a chance, then it is in the KRA website. If you could get it and read it, and we'd be happy to hear from you if there are any specific loopholes. I have to say, generally, the issues of compliance are well structured in terms of management, and if there are any gaps, then we have a team that I believe are capable of dealing with all those people, for example, doing business on Saturdays and Sundays and not issuing ETRs. And we'll be happy to get that information from you on those people. Asha raised the issue of installment taxes and the issue of this being not rolled to the next month, and the system charges penalties for not making further payments. I think this is a personal issue, and again, Asha, I would request if we could have the conversation so that we deal with your issue specifically. On the issues raised by Asha, still on the issue of VAA, again, these are issues that I believe are specific to you, and we can deal with them outside the forum.
Sure.
TOT, you mentioned that the TOT is back. Yes, I can say that it is in the finance bill, but we are waiting for the approval of the finance bill by the president. So if it is assented to, then it will be, TOT will be enforceable from the date of assent of the bill. It will be, I need to clarify that the rate of TOT has remained that in the bill is 3%, and also the presumptive tax is also retained, but the payment for the presumptive tax will be used as an advance tax. So you will not pay advance tax and also TOT. You pay advance tax, but when the payment for TOT is made, then you deduct the amount that you paid as TOT. So there will be no two taxes. The payment for TOT is monthly, and the same is for advance tax, the presumptive tax, which, as you are aware, is 15% of the county government license fee.
Good. Thank you so much, Maurice Ray. I'd like to thank my panelists for being very engaging. This is a subject that I think can take a whole day. Thank you, Mercy, for coming through for us. Thank you, Engineer Obam. Maurice Ray, always a pleasure. Thank you, Dr. Kate Kitao. And indeed, Alex, thank you so much, and you've been a wonderful audience. Asanteni sana. Thank you.
All right, a round of applause for all the panelists up there. Kindly just be seated. Just be seated for one moment.
You're welcome.
Our panelists, just be seated kindly. Thank you so much. Just we're trying to finish up something, Dr. Ari. Kindly just be seated. Asante sana. And there was a very burning question for Catherine Getao. Someone wanted to know what are the likely pitfalls when it comes to taxation of the digital economy. Would you answer that briefly? What are the likely pitfalls when it comes to taxation of the digital economy from the ICT perspective? I was told it's a very pertinent question that has to be addressed by yourself.
Okay, I'm very embarrassed to be asking questions when we had closed. Well, there are pitfalls, but there are also opportunities. I'm sitting here thinking that some of the people who need to be in this multi-stakeholder conversation, and I'm picking from what Abigail said, from what Francis said, and several other people said about their dissatisfaction. I think Aisha, technology is the problem, technology is also the answer. Technology can deal with very complex tax regimes and make it simple for human beings. We've seen right now, it costs me 50% to travel from the central business district to my house than what it did 2 or 3 years ago. And that is because technology has made it more efficient for the taxi driver to get enough business in the day. And I think this is what has to happen to taxation as well. The reason why we're paying too much, Francis, is because too few of us are paying. As we make taxation efficient, easy, and easy to apply using technology, then the cost of taxation to each individual should be able to go down, because we're not just collecting taxes for fun, we're collecting taxes for costs which are incurred by the government. Pitfalls, people will move, yes, to other places, and I think that has already referred to. People will choose not to locate, and technology makes it much easier. The traditional Facebook would have had a big office here, and it would have been difficult for them to move. Now I think they can move in 5 seconds if they're not happy with our environment, because it's, you know, they're in the digital space. So I think we need to be conscious of that. Okay. There can also be tit for tat. Okay. So we're expecting our young people to start making their careers in this digital space. If we make it, and they want to be global, when you become, the digital economy is not, it's national, but more than that, it opens borders. Okay. If we make things very difficult for other people, they're going to start making things very difficult for our young people who are trying to break into the global space. Okay. So these are all pitfalls, or I don't want to call them pitfalls. I think they're challenges which we must discuss and make Kenya the most attractive digital space, so that when people are running away from others, they're coming here.
All right.
So thank you very much.
Thank you so much. A round of applause for our able panelists for a very engaging conversation. Asanteni sana.